Welcome to the Teaminvest Wealth Builders podcast with your host, Kerry Fleming. Each episode, we bring you powerful insights, proven strategies, and real stories to help you compound your wealth and knowledge. So whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you.
Welcome to this week's episode of Teaminvest Wealth Builders. With me today, I have Sanjee Narendran. Sanjee is our head of funds management and education here at Tip Group. But Sanjee has spent a large majority of his career as a stockbroker. Today, I'll speak with Sanjee about looking behind the product and what that means for us as investors. Welcome to this week's episode. This week, we're talking on a really interesting topic called Beyond the Product. And with me today, I have Sanjee.
Hi, Kerry.
Sanjee, what do you mean by that?
Well, if we're looking beyond the product, quite often we get great businesses or great business ideas that come out to market, and they've got really fascinating products or a great service that they offer. And sometimes, or quite often, they're the first with the new innovative idea and they want to get out to market first. But as an investment, do they necessarily make great investments? So I think that's an idea we'd like to explore a bit further.
And that's a tough one, right? Because when you have a shiny new object, everybody wants in. Everybody wants to be a part of this next big thing. So what are the things that we need to be aware of?
Well, quite often we get carried away with thinking about first mover advantage. And it's so often that you think, okay, the first movers end up taking up a huge market share and so hard to compete.
Yeah.
But if you think back in history, you look at ideas and concepts and things that have come out in the past, and what's big now, they weren't necessarily the first movers there in that space. Like a great example is Yahoo. Yahoo came out where they were supplying email addresses. They were your front web page, your homepage. You had your news content on there. You had your chats on there. It was a great tool. Then all of a sudden, Google came out. When Google came out, Microsoft came out with their versions, essentially ended up wiping Yahoo off the map. So there's a difference between having a great idea and a great concept or a great product or service and having a great business.
And that's the thing. We're not saying it's a bad idea.
No.
The ideas have carried through. Somebody else has picked it up.
That's right.
But
they've just made it work a lot better.
Yeah.
Or they've done something to go and take that market share away. And it's not a unique concept to have done that. You see that repeated many, many times in the past. Another typical example is everyone was on MySpace. If you think back when we were all on MySpace, it was a great concept, had that social network around there. You could connect with your friends, post what you were up to, and then comes along Facebook.
Yeah.
Now, MySpace, what? The younger generation, my kid wouldn't have a clue what MySpace is.
You only see it in the movies now.
That's right.
Mentioned.
And even now, Facebook is still around, but it's been taken over by Instagram and Snapchat and all sorts of new social media apps that are out there. So being a first mover and getting into that space is big. It's an advantage. It takes you to a certain position, but usually the benefits are really won by the second and third comers to the market because they've seen the pitfalls. They've seen you've gone through as a business to get there.
Yeah.
And they've managed to just use that to get to ride along and just get on top of you. And what tends to happen is if you're going out to market with a whole new business or a new idea, it's going to cost a lot of money. There's a lot of research that goes into it, a lot of development that goes into it. You get it wrong so many times. You have to keep persevering and eventually you crack through. And if you're a MySpace or a Yahoo or something like that, you've used up a lot of investors' money, raising capital, sometimes taking on debt. And you hear these stories from these founders that have done that. And they've managed to make their inroads, get the first mover advantage, get into that space, only to have somebody else come in and just take it away from them by coming up with everything you're doing, but just better.
So in saying that, are we saying that it's, from an investor perspective, it's a bad thing to get into a new idea?
Absolutely not. It's not a bad thing. But what you want to do as an investor, especially if you're a long-term investor that
Yeah.
wants to make an investment decision rather than just make speculations on what may or may not work out, you want to see that the idea has had enough time for it to develop, stand on its own 2 feet, make money, and look beyond the product or service and look at how the business is run. So you get, usually with a new startup, you get venture capital money, you get people investing in there.
Yeah.
It's very difficult for them to get loans. So when they do get loans, the interest rates are very high because they carry a very high risk.
Yeah.
And what we got to keep in mind as an investor is, if a business is going out and getting loans and they're getting loans at a high interest rate and a high classified by banks as high risk, if anything goes bad, the banks are going to get their money first. The lenders will get their money first, and shareholders will get what's carried over after all of that.
Right. So it's definitely going in with your eyes open.
That's right.
Yeah.
But in most cases, they're not making profits. They won't make profits for a long time. They've got so much capital that they've burnt to get to market, break through a market, and be present there and start running a business and just starting to make money.
Yeah.
That there is a very long lead time for them to actually turn themselves into a business that makes it a worthwhile investment. And more often than not, it's not the first movers that do it.
Right. So as an investor, what are, I guess, the key indicators that we're looking for when you say it's that, that transition between it being a new idea and everything being tested and going into that stage where it's potentially a good investment?
Well, before we look at any investment, we want to see 10 years of history of being listed. So a business may be operational for 20 years, may have only been listed for 5 of them.
Yeah.
It still doesn't cut it with us or Teaminvest and the Teaminvest members before we would consider it. We'd want to see a little bit longer of a period.
Yeah.
Because statistically, if you keep rolling or flipping a coin or rolling a dice, you're going to have many situations where you get multiple heads in a row or multiple tails in a row, or keep rolling double sixes. It will happen as long as you keep doing it enough times.
Yeah.
So you will get those that keep passing through and being able to show a consecutive 5-year worth of good history.
Yeah.
But if that goes to 7 years, 10 years, that is less and less likely to occur. So when we're looking at 10 years worth of history, we know that this is not a statistical anomaly. This is something that management has done. They've been able to make profits consistently for 10 years, good profits.
Yeah.
They've been able to grow those profits. And then we look at how much risk does management have. And management is a huge part of operating a business.
Absolutely.
And in a lot of cases, it plays a even bigger role, the capability and the ability for management to apply a strategy, roll out a strategy, and get things done than it does for the product or service.
So how do we determine that? So we've spoken about the product, but how do we determine good management?
Well, I'd say what we do is you'd look at the indicators first, look at the history, look at the business first.
Yeah.
Once you're comfortable with the business aspect of it. The business has been making money. They've made money for a long enough period of time.
Yeah.
You then want to have a look at the management of it. How are they making management decisions? Are they taking on lots of debt? Are they continually raising capital? And when they've done it, are they including us shareholders? Are they thinking about us, or are they only thinking about their roles as the CEO or the MD of the company? Do they have their own skin in the game?
Yeah, that's a big indicator, right?
Do it. If they are holding a reasonable or considerable position in the business, then you know that they're going to act in the best interest of them as a shareholder, as well as us as shareholders. We become aligned. The other way to look at management is look at the remuneration report and have a look and see how they're remunerated, especially what they're incentivized on, their short-term incentives, but in a lot of cases, the long-term incentives give a lot away. And then see, are they aligned with shareholder values?
Okay.
Because there's many structures of remuneration that allows you to take on extra capital, take extra risk, do things that may increase the share price, but not increase the profitability of the business. When the share price increases, but the business's profitability doesn't, or it doesn't keep up, the share price never stays there.
Right.
And if we want to be a long-term investor, hold the company hopefully forever, but at least a 5 to 10 year period, you want to know that the earnings of the company are going to continually grow. And because of that, there's no way for the share price not to grow.
So when we talk about looking at the remuneration structure of the management, firstly, where do we find that? But secondly, what are we specifically looking out for?
Well, the best place to find it is the annual report. So every year in the annual report, on the ASX, they actually detail out management remuneration structures. They tell you how they're incentivized, what their key performance indicators are. Sometimes they don't give you as much detail. Sometimes they give you more, but that's a telling sign of how forthcoming they are with treating us shareholders as partners in the business.
Yeah.
And giving us that insight and information as to how management is remunerated. At the AGMs, we have that opportunity to vote on management remuneration as well.
Yeah.
We can say whether we like it or not. Sometimes the board or the organization may decide not to go ahead with the shareholder votes, and there's little clauses here and there that can get away from it, but that in itself is a telling sign.
Yeah.
But the idea is to see that you want management to be focused on the business. That is something the management can be hands-on with and control. Expecting the management to be focused on the share price, you're now getting into that realms of not being focused on the business, but focusing on growing the shares. And you do that as management via excessive marketing, excessive promotion and investor relations, and talking to all hedge fund managers and all different firms to try and spruik up the share price. They get into a position of selling great stories, great opportunities, but they spend no time in actually delivering it. So if they're incentivized by the share price can move with a great story.
But it doesn't necessarily reflect the health of the business.
Exactly.
Yeah.
So what we'd like to see is we look for a management that's incentivized by growing their earnings. Their earnings per share is a good calculation to use.
Yep.
To see how much of their incentive banks on them controlling profitability. Because you want management of a business to make that business profitable.
Yeah.
You won't get a business that goes bankrupt when you keep being profitable, when you're not overexposed on debt. And if in the worst case, a business like that does for somehow, some way, some reason go belly up, there is enough equity, there is enough for shareholders to get some value back out of that.
I love the fact that we've been able to go through this today, but I'd like to take it a step further. Now that we've got this knowledge, how do we apply it? How have you seen it work in the past in the things that you've been involved in?
Well, this is a integral part of the Teaminvest principles. And this is how Teaminvest members invest their own funds
Yeah.
and how we manage our fund, the Conscious Investor Fund. And if you want to have a look at the results of applying that level of thinking to your investments, a Conscious Investor Fund's a great benchmark. And if you see the Conscious Investor Fund as a pure equities fund, it's been running for 13 years and it's delivering over an 11% return for the last 13 years, which if you compare that to equities funds in the market, in most cases, you don't see equities funds that old. And why is that? Because it's not because equities haven't been a product or there hasn't been funds on them. Those funds were run, they were closed, they started new funds, the new funds were run for a while, and they take their best. When they start to stop performing, that's when fund managers close down their funds and start a new one.
And that's a sign that they've invested in those companies that don't have the longevity and that longevity of the returns.
Exactly. So they've grown their funds, they've invested, they've stopped performing, now they've cut them off, started a new one, and let's focus all our attention on the new shiny thing over here. But if you think about our fund, which has been running for 13 years, delivering an average of over 11%, considering the market average return is about 8.5%, we've outperformed the market significantly.
Yeah.
But beyond that, people investing their own portfolios, Teaminvest members, they're making 15 to 20% on average in the same period, even longer.
Yeah.
And they are actively applying that methodology. Same thing I do with my portfolio, we do with the funds. We apply that methodology where we look at the business, we look at the product and service, but we take that deeper thinking. We really want that company to hold on to that product and service, hold on to their moats, and make sure that they can't be breached by any competitors taking away market share. And you really need to give that enough time before you make that investment decision if you want to hold it and make some serious money out of it.
Yeah. So we're not talking about a theory or a good idea here. We're talking about something that we've seen work.
Absolutely. This is exactly what we talk about. So anything that we say at Teaminvest, it's all based on research.
Yeah.
And we have the data. We have, as they say, the receipts to back it up. So we have the data to back it up. We can show you the performance of the funds. The fund investors have made some serious money out of being able to follow it. The members have made money doing the same thing their way. And that's why some of our earliest members are still with us today. We don't get a lot of people leaving because once they've found Teaminvest and once they've started making that kind of money, they're lifers.
Yeah. Yeah. I mean, I know for myself, I've been in the industry for a number of years. And when I discovered Teaminvest and the methodology behind their investments, it just gave me that sense of peace and calm that we don't have to be speculative or guessing. We actually have research to back our decisions.
Absolutely. And even in my career as a stockbroker, I was stockbroking for over 20 years. I've raised capital for firms and I've been part of that process. And I know what happens is over 90% of the companies, I'd say over 95% of the companies listed on the exchange are listed because they are there to raise capital. That is one of the primary benefits of getting a listing.
Yeah.
Because it's expensive. You're giving away 6 to 8% of the money you raise to a broker to raise money for you and get listed. The whole thing is a very expensive process, doing due diligence, getting the reports done. There's IPO prospectuses done. There's lawyers involved, there's auditors involved, there's accountants, there's ASX fees, ASIC fees. It's a huge process. But you undertake that because you know that there is a pool of capital by being listed I have access to.
Right.
There is a small group of a subset of companies that list for other reasons. Things like compliance listings or being able to win work and get large contracts and government contracts and make deals with large vendors that get comfort out of only dealing with other listed companies.
Right.
But most companies that list on the ASX do so because they need the money. And when you're listing and a company needs the money, in our positions as brokers, or in my former position as a broker,
Yep.
what do? You come up with the best story you can. You come up with these great stories to say why this company is going to revolutionize the space, why it's going to make so much money, and this is the next big thing. Because you will never raise money by going out and saying, oh, there's a competitor in this space, these guys are coming in, and they're just going to do a lot better. And they want to know how, why, what makes you guys better, there needs to be a great story and a great opportunity. And you're not going to do that without any money. They're raising the money to invest into these businesses. And a business that needs the money means they're not making their own.
Yeah. Yeah. So just because something's listed on the ASX doesn't necessarily make it a good investment.
That's right. Many companies on the ASX have been listed for so long. Maybe in the initial stages, they needed the money or they had other reasons to get on there. That's fine. But they've now been listed so long, over 10 years at least, where they've been making their own money. And those ideas that they took when they wanted to list have actually worked out. Management was able to do it.
Yeah.
They've now proven their success. And now that it's been proven, it's a time that we want to get in because we know that this is going to be a lot stabler. We'll be able to sleep at night knowing that the holdings we have are being managed by really capable people. But until someone's proven themselves, you're just taking a gamble and pitching an idea on a great story. And if it was me, I'd rather buy a book to read a great story than invest much more into our company just to see it fall apart.
Yeah, just to figure out whether it is actually a great story.
Yeah, I mean, and I've heard so many great stories out there.
Yeah.
Great companies, great stories, great innovations. But where are they now?
Yeah. And I guess that's where you step back and go, well, what do I want to invest in? And what am I investing for?
Yeah, that's right. It's not for everybody. Some people do want to back those early winners and that's what you want to do and that's what you want to speculate on. Great, go ahead, do that. But that's a speculation.
Yeah.
And be aware, just be conscious of what you're doing. You are speculating.
Yeah.
And there's nothing wrong with that if that is your strategy and that's what you want to do.
Yeah.
But it is much more work and much harder to do than being an investor, making informed decisions on facts and evidence.
Yeah. It just gives you that peace of mind.
Absolutely.
It's got that backing. It's got that research backing. Okay. So I guess to kind of wrap up what we've gone through, it's really separating the product from the business.
Yeah. The product is important. Don't get me wrong. You need to actually look at the product, the service, and say, is there an room for that product in the marketplace? Is it something that's likely to be adopted? But go a little bit deeper and think, okay, if it's adopted, what can come and take this out? What are the modes? How do they keep competitors away from coming in and taking over the market share that they may have been first to move on or they've acquired in some way or another? So you think about the product. Don't disregard it completely, but just balance it out and give a lot of weighting towards how the management is running the business. Are they protecting those modes, protecting you from your competitors?
Yeah.
And are they managing your risks well? Are they incentivized to align with your strategies and your intentions for the business? And are they focused on making money? And if they are, they'll make us money through that process too.
So you've potentially got a good investment there.
That's when you know you're onto a winner.
Yeah. Oh, this has been really interesting, and I hope that you found it really, really helpful. Thank you so much, Sanjee. And we'll look forward to seeing you next time.
Thanks, Kerry. It's been great.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you would like to learn more about Teaminvest, Tip Group, or our unique investment approach, visit us at tipgroup.com.au. And don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.